Okay, now what are interest rates? It's the cost of borrowing money. Everything has a cost. Okay, maybe you got a couple friends who will lend you their car, and they do it for free. But reality is everything has a cost, and they're probably expecting you to lend them your car at some point. So let's put it down to interest rates. What that means. You want to borrow my money. I'm going to charge you money to borrow it. Obviously, you're not going to be able to pay it right now, but at some point in the future, you need to. So imagine some dude named Ted is borrowing $10 from Bob at an interest rate of 10% a week. After 1 week, how much does he owe? After 2 weeks, how much does he owe? Well, if it's $10 and it's simple interest, then I'm saying that every week at 10%, he's going to owe me $1. So after 1 week, Bob's got to pay me back my principal, the $10, plus another dollar, makes it 11. 2 weeks, he's got to pay me back 12. I'm just going to give you a second to appreciate that meme because it is money. All right, public and private investments. What are they? Well, a privately held firm is owned by its founders, management, or private investors. Okay, what that means is people like you and me don't have access to them. Okay, we can't buy ownership in them. We can't buy what's called equity to expect increases on some sort of investment because they are cut off from us. Most companies start out as privately held firms. You know, your Facebook garage startups, your incredible product out of Utah County companies. They start out private and then they eventually go public. So a publicly held firm is a firm where you and I have access to its ownership. That doesn't mean we're going to be in charge of the firm. That means we're going to own a really small portion of it. And what matters is that when we own that small portion of it, the value of that portion has the potential to increase or decrease. Okay, and we can benefit from that increase or decrease. We can benefit from the changes. So those shares are commonly referred to as stocks, and when a company goes public, they have what's called an IPO. It's an initial public offering, and the first time they go public, they are pretty much launching a massive fundraiser saying, you buy ownership in our company, you give us money, and we give you the value of ownership in our company. And what you can eventually do with that value is sell it in the secondary market, the stock market. Okay, so here's two famous examples of public and private firms, and these are important because we're going to continue to use Microsoft throughout a lot of these. SpaceX doesn't really come up too much, but you're familiar with both of them. Both really cool companies, SpaceX, Elon Musk, Microsoft, Bill Gates. Microsoft has some pretty cool stuff about when it launched its IPO and how fast it went from, I think it was like $21, jumped to $27 before the day closed. So just interesting little facts. All right. Now, next part is investment markets. Okay, so we're just going to briefly discuss what the sorts of investment markets are. We're going to get into what the investment vehicles or what things you can invest in those markets in later chapters. So here's some words to know. They're a little bit intimidating. Don't worry, they're super simple once you just get a grasp on them. I encourage you to Google them, and that will help a lot. Okay, so I want you to look up what assets are, look up what liquidity is, interest, vehicles, and inflation. Get your head wrapped around them, and we'll keep going, and I'll expect that by this point you know what they are. Okay, so money markets. Money market is the home for very short-term debt securities. It's almost exclusively used by the government and other really, really big firms just so they can meet short-term obligations like payroll. The reason they're the ones who use these is because money markets have really, really low interest rates on them. That means that companies can use them to take out debt when they need to meet short-term obligations and pay back that debt in a relatively quick manner without accruing a significant amount of interest. Okay, so they can buy into these money markets directly through brokerages, mutual funds, You and I can buy into money markets if we want, because obviously there's two sides to this. There's the person who's taking the debt and the person who's giving the debt, and so those companies have to pay people back, and people like you and I can be the people who they pay back. All right, bond markets. Alrighty, so now we're going to dive into investment markets. And we're not going to specifically talk about the things in those markets that you invest in. By that I mean the vehicles you invest in. I'm talking about where those vehicles, where those things live. Okay, they're sort of ecosystems. Those are the markets. Okay, before we dive into it, pause this video, Google these words, get a good grip on them. And when I say vehicles here, I don't mean cars. Okay, I'm talking about investment vehicles. Okay, so the first market we're going to talk about is money markets. All right, so pretty simple. Money markets are home for very short-term debt securities. To get the point across, you've got governments, you've got huge firms who have short-term obligations. McDonald's has to pay their payroll every 2 weeks. A McDonald's cashier is not going to be okay with not getting his paycheck on time. What that means, because McDonald's is a huge company, and yeah, they have lots of cash, but they're not always going to have the exact amount of liquid cash to meet their payroll. That means they don't have cash just on hand to go hand out to their cashiers or the people that work for them. They need to buy money, liquid cash from somewhere else, and the place they go to buy that liquid cash is money markets. So money markets are, like I said, home for very short-term debt. So what these companies do is they take out short-term debt to meet their short-term obligations, and obviously someone has to sell them that debt, and people like you and I can be on the other side of that equation. We can be the ones who give McDonald's or give the government a little bit of cash for them to meet their payrolls and accrue by the transaction of that cash just a little bit of interest on top. Hopefully within the next day or two, they'll pay us back. Money markets are almost always safe. You can access them through brokers and brokerages. The only time a money market got questioned was 2008, and that was just crazy stuff. So next part is bond markets. So where money markets were home for short term, bond markets are home for long-term debt. Okay, so bonds are typically used by the government and businesses to raise money for some sort of big project that they got going on. It has nothing to do with James Bond, by the way. So you're gonna hear a lot about bonds from schools. You're going to hear a lot about them from treasuries. You hear about war bonds anytime you watch a World War II movie. You can buy bonds directly from the U.S. government or through a broker such as Goldman Sachs. Now, I know I haven't explained how they work yet. It's because I'm going to explain it right here. So it's a pretty straightforward process. Okay, you, me, the investor, we give some sum of money, okay, typically cash, to the bond issuer, whether that's the government or a huge company. And now that we've given them a bunch of money, they're going to go do whatever they have to do with that money. Build a school, build a road, go fight a war. Okay, but what they sign a contract to do in return is little by little, over a long period of time, depending on the extent of the bond, they are going to pay us back. And every time they pay us back, they're going to pay a little bit of interest as well. And eventually what they're going to be paying back is that entire sum of capital that we paid, okay? And then on top of that sum, it's called the principal, they're going to pay that interest as well. Okay, so bonds are not just perfectly straightforward. And the fact of the matter is, it's highly unlikely that you are just going to intuitively grasp how they work in the matter of me explaining it right here. You're going to have to go in and do a little work on your own and learn about them if you really want to. Okay, so the reason I'm getting at that is what I'm about to explain. You can see there's something called premium and discount bonds here. What those are is bonds that are sold on what's called the secondary market. Okay, and what I mean by that is not only can bonds be bought initially from whoever is the issuer of the debt, whether that's the government or a huge company, they need to raise money to go build a road, or they need to raise money to go to war or for a new project. Not only can I buy bond directly from that entity, but I can also buy bonds from people who have bought bonds, right? What I'm saying is there can be a secondary transaction. You can buy someone else's debt because you're interested in holding debt that's going to make you money in the future. And when those bonds are sold on what's called the secondary market, like I said, they trade at different prices. Most bonds are almost always priced initially at 1,000. That's when they first come on the market. First time a bond is being sold from debt issuer to investor. But when they're traded on the secondary market, they trade at what's called premiums and discounts. Okay, premium bonds are priced above $1,000. The reasoning for that is because a premium bond means that whatever interest rate it got locked in at when that issuer began its project and had to sell some debt, it is locked in at a higher interest rate than what the current interest rate is, which means that the interest rate it's locked in at is more valuable. It's making more money than all the other debt is. And so those are sold on the secondary market for prices above 1,000 because they're simply put, their interest is better. They're going to make you more money. Now, discount bonds are the opposite of that. So when the current interest rate is higher, meaning if I were to go take out debt, or to go buy debt from someone else today, I'd have a higher interest rate. Well, that means that the bond price, what I pay for on the secondary market, needs to be sold for lower. Okay, what really helped me grasp the idea of bonds and how they worked was when my professor, the guy who actually instructed all of us for this course, Rick Haskell, showed it to me. Okay, so back in the day when a war bond was sold, I think this one is actually from the Spanish War. It's 1898. So yeah, back when they used to do bonds like this, what they would have was they would have the contract of the bond, and then they'd have a bunch of these tiny little coupons. And every time your coupon payment came due, every time it was ready for the government to pay you the coupon payment, you'd go and you would cut one of these out at the bank. And in exchange for one of these little coupons, after you cut it out, they would give you liquid cash. All right, super cool. Okay, the next part is stock markets, and we're going to get really into stocks further on in the chapters, but we just need to get basic idea of what a stock market is. So companies, in order to raise capital and just grow, will sell shares of ownership in their company, and that ownership is valuable, and that value is known as a stock. Okay, so I can buy company shares and take real tiny partial ownership of the company, and in turn, as that value grows and fluctuates, whether it changes by increase or decrease, there might be some value in that change which I can take advantage of, and so that's what stock markets consist of. You can get them through lots of different things. You can buy stocks, straight up just one share of Microsoft stock, or you can buy them in bundles like ETFs and mutual funds. Often stocks will come in groups, so you'll have like a group of semiconductor companies that pooled their shares together, and you can buy ownership in that sort of pool of shares, and as that value fluctuates, you make money. Okay, if that didn't totally make sense to you, that is okay, because we're going to get more into stocks, especially further on, because that word is thrown around so much, and we need a good understanding of it. Okay, so you might be asking yourself, well, if a company just initially raises money and sells shares of stock, what makes those shares change in their value? Well, it's the same answer anytime you ask why anything changes in the economy? It is because there is scarcity. There is a finite amount of ownership. There are a finite amount of shares in a company, and the demand or lack of demand for that company's shares is going to determine how expensive or non-expensive they are. Okay, most of that demand ends up being determined by the company's actual performance, because if a company goes bankrupt, then the stock loses all of its value. Which means that if the company gets closer to being bankrupt, the stock is going to trade for a less expensive amount because people think that it's not going to be a worthwhile investment as far as a long position goes. So, these are some questions you can ask before you invest in a stock.